easier. Okay, so this should be recording. So hello everyone. Ryan's just asked me about the group project, and in particular has said, how would you go about structuring, or if I'm paraphrasing here, how would you go about structuring the report if you're looking at more than one company? My response to that is going to be, assuming that your companies are in the same industry or a similar industry, you can effectively do, here's the characteristics of the industry that we're playing in. Here's how our two firms are positioned within the industry. Then I think it would be sensible as far as doing your performance or your ratio analysis. You might want to, you do the two companies that you've been working on so far. You then might want to say, look, and we will compare this with either another company that happens to, and here's why we think this other company is a good one to compare performance to, because it's either the dominant player or it's a similar size or it's doing similar things. Or you could say, look, we'll compare it to the industry average, and we've kind of talked online about the pros and cons of narrow versus wide industry definitions when you're doing that. So certainly the companies that each group member is doing would be in kind of like, I would envisage that as kind of one table: company A, company B, company C ratios. And then I think in terms of describing the performance, as you probably want to tease out, look, why do you think, based on what the firms are doing, why do you think performance is differing, and what's giving rise to that? And again, then when you're doing the forecasting and the valuation, you'll obviously want a forecast and valuation for each company. And so that's, and then so look here, company A valuation, company B valuation.
And key accounting policies that might vary across companies, and then maybe even comparables as well. Is that part of this, or we're not necessarily?
Again, if you're doing similar industry, then to save space, I think you'd be able to plausibly say, for this industry, what industry are you doing, Ryan?
Pharma.
Okay. Yeah, for pharma, here are the key accounting issues. And you then might want to say, look, our company A and company B have both seem to have made similar decisions, or company A's gone this way, company B's gone this way, which, and then I think the better analysis that people are going to be doing, saying, and either that's consistent with differences in their underlying business models, or it's inconsistent and we're kind of not quite sure why as well. But I think you wouldn't need to say the major accounting issues for company A are blah, 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 blah. And look, I don't think it's helping you too much to say that obviously R&D is important for pharma companies. That's kind of, I think everyone would get that as the first one. So treatment of R&D, here's what they're required to do. Company A does this, company B does this, or company A doesn't, company B doesn't. Yeah. So I think you can do at least a good chunk of that at the industry level. Yeah. If you're thinking about the incentives, it's the incentives that we've talked about in terms of, do we think that they have to hit any earnings related targets? We do know that varies systematically by industry. And by that I mean, there are certain industries where there's typically a large amount of debt. And if there's a large amount of debt, there's typically borrowing agreements. If there's borrowing agreements, you've typically got covenants in those borrowing agreements, some of which are going to be written around financial statement numbers. So minimum net worth must be, so interest coverage must be above. Minimum tangible net worth, or dividend payout can't exceed. So all of these sorts of things are likely to vary systematically by industry. Where you might get things that differ is, if we're thinking about the contractual stuff, could be bonus plans for the firms might vary. And so you might be able to say, look, yeah, interestingly, they don't have, or either they do or they don't have similar short and long-term incentive programs in place. And again, depending on the nature of the firms that you're looking at, we might be able to say, and this is expected because firm A is a large, mature, been around for 150 years company, and firm B is recently listed with CEO, founder, who still has a huge proportion of their personal wealth tied up in the firm. So you can say, look, the differences make sense or the differences don't make sense.
Great. I think that's it from the project perspective.
Yeah. Okay, so Ryan's just asked me about the issue of terminal values in our in our valuation models, and the issues that we face when we're trying to implement a perpetuity, either stable or a growing, or a multiple. So a couple of thoughts that I have on that is that the first one is that at terminal value, we are making an assumption that other than revenue growth, which is going to drive either our free cash flows or our earnings-based models, every other ratio is going to be constant. So profit margins are constant, turnover is constant, capital structure is constant, cost of debt's constant. So everything's stable. What that means kind of algebraically or mathematically is that revenue growth will be the same as your free cash flow growth or your abnormal earnings growth. So everything's growing at revenue growth. Second thing that you want to consider when you're thinking about these terminal values is you're assuming that this happens forever. So we're not just talking about 5 or 10 or 20 years, it's assuming what happens forever. So here we need to be careful about thinking about what sort of factors could drive long-term revenue growth for your business or your industry. Usually, that's going to come down to some typical macroeconomic indicators. And if people can just log on to the ABS, the Australian Bureau of Statistics website, abs.gov.au, you've got a list of statistics up the top, and they represent good candidate statistics. And that'd be things like GDP growth, population growth, average weekly earnings growth, inflation, and so on. So as I said, for a large number of firms, they're going to be the sorts of things that you would ground your long-term growth forecasts in, because you're thinking about what's likely to be the demand for your products. So how many people are out there? How much have they got to spend? How much are they going to spend on your product? So that's the general setting of these growth models. If we think about using, say, a perpetuity, so a kind of payment divided by R minus G, that's mathematically the same as a multiple. So there's kind of the multiple is 1 over your kind of R minus G. So I view using a multiple and using that kind of perpetuity factor as the same thing. They're kind of algebraically equivalent. You just want to make sure that what you've got is plausible. So obviously if we're using sort of a growing perpetuity, we're kind of constrained by R minus G, has to be positive. In other words, we can't have growth above the cost of capital or the cost of equity capital if we're valuing shares, because then we end up getting silly numbers. We get a negative denominator in that terminal value calculation, which doesn't make sense. So R minus G algebraically means the growth can't exceed cost of capital. If we think about economically what the implications of that are, it's difficult for most plausible cost of equity capital estimates to imagine how growth could exceed that forever. That kind of statement you could argue with a little bit in the last 2 years, where we had, say, record low risk-free rates. We had, kind of, depending on what your view was on equity risk premiums, and depending on what your firm's beta were, you could come up with a kind of a historically low cost of equity capital. But long-term, over a large number of businesses, having a terminal value growth rate in excess of your cost of capital is not plausible, because you kind of start forecasting things out. Your firm will get bigger than the industry and then bigger than the economy pretty quickly. So one thing that you want to consider if you're looking at a current multiple, as I said, you can convert a multiple into kind of like a payment divided by R minus G pretty easily. It's just a 1 divided by the multiple will get you your R minus G. What you want to consider is the extent to which the multiple or the combination of R and G that would give rise to that multiple. And it might make sense if I kind of just do a kind of a brief numerical illustration and throw that up on the Teams page, just so that people are absolutely clear on what I'm talking about. But you want to have a sense of whether a current multiple, whatever it happens to be that you're looking at, like a price earnings ratio, to what extent is that likely to persist in the future? And that's where we link this back to what we've done for the business strategy, the industry conditions, and so on. What it does mean is that for a large number of businesses, the G part of R minus G is probably going to be within a pretty narrow range. For a lot of businesses, long-term GDP growth is going to kind of be a good proxy. Now, we do know that that does vary kind of across country, but again, within a kind of what I describe as a relatively narrow range. One thing that I see in these sorts of projects a bit is the temptation to fiddle with the G, the long-term assumed growth or the terminal value growth assumption, to generate the prevailing share price. And I always encourage people not to do that. Use what you think is a plausible growth rate, see what the share price is. So, well, either the market's thinking similar to what I am thinking, or the market is not. And do I think the market has got this right or wrong? Kind of then becomes the next question. So that's kind of a longish-winded response to sort of thinking about this terminal value question. I guess the other way of thinking about that is that, so when do I become concerned about the terminal value assumptions? Well, one thing that might drive my level of concern is the proportion of value that I estimate that is captured in that terminal value. So in other words, once I do my detailed year-by-year forecasting out to when I think the firm's likely to be stable, and the kind of the mean reverting pattern suggests that that's probably somewhere in the 5 to 10 year mark for most firms, most industries. What I mean by the proportion of value captured in terminal value is thinking about, look at your terminal value discounted back into dollars today, look at overall value, calculate that as a percentage. The larger the terminal value is as a percentage, the more you probably want to be thinking about, are these reasonable assumptions or not? So firms that are at this point in their life cycle, young, growing, and so on, you're probably going to get relatively large terminal values. A established big firm in a kind of a declining industry, for example, is probably going to have a smaller terminal value rather than larger terminal value. So excuse me. So I finally pinged positive to COVID yesterday.
Gosh, yeah.
So after 2.5 years, but yeah, that's kind of my that's my terminal value thoughts.
So if we're trying to sort of sense check what they're currently trading at, I guess we're using, if someone's currently trading at a really high multiple, potentially we use that, compare that multiple versus our terminal multiple, and then we say, well, maybe we need to expand the years that we're building this out over, or maybe our pre-existing assumptions are not aggressive enough.
Yeah, and if your ship, let's say we do a valuation model, we come up with $50, market says $100, for example.
Mm-hmm.
Yeah, there are a couple of reasons. So it could well be, and one of the reasons might be, if we've cut off at 5 and the market's kind of doing its internal, so the consensus kind of detailed forecasting that the market's doing is 10 years, and we've got different sets of assumptions in that 5 to 10 year period, that could be a reason. We're also, again, if we look at what's happened in the last couple of years, the idea that prices are always correct has taken a bit of a battering. And so it could be the price is 100 because we happen to do this exercise in October or November in 2021, when all of the money sloshing around in the markets was meaning that every asset class in retrospect was overvalued and has come off. So it's part of it could be, even though in general, we like to think that prices are going to approach fundamentals eventually. There's certainly enough anecdotal evidence out there, and we don't need to look too far, as I said, in the last 12 months to see, well, yeah, things have obviously come off a lot in the first half of this year. So it might just be that the market's over aggressive at the moment. But I guess the other way of thinking about it is, what's the other way of thinking about the prevailing share prices? Well, given the model that I've developed, what set of assumptions do I need to put in to get the prevailing share price?
Working backwards.
And can I tell a story where those assumptions make sense? And it's kind of like, well, they're going to need to get a return on equity of 35% and grow at 4.5% forever. Maybe that's a bit aggressive. And so you can do the thinking or working your way of thinking about it. So in effect, reverse engineering what the set of, or the combination of assumptions that work to get the prevailing share price, and get a view on, I don't know, maybe we can tweak discount rates, maybe we can tweak the growth, maybe we can tweak profitability. But it's like they've got this level, and just say, look, can I tell a story that makes it work, or do I just think I'm missing something that the market is getting, or the market's more pessimistic than I am. For what it's worth, when I kind of, whatever company I tend to pick to do as the example company in this type of a course, almost always my estimate of what I think is a fair price is under the prevailing market price. Almost always. I can think of one or two examples where that hasn't been the case. On average, my estimates are more conservative than the markets, is the way I describe that.
That captures that one for me.